Donchian's great contribution to the world of finance was a quiet revolution in thought. He asked a different, more humble, and ultimately more powerful question. Instead of trying to be a genius who can outwit the market, what if one could simply build a better machine? A machine that would be immune to fear, greed, and hope. A system that would not attempt to predict the future, but would simply react with unwavering discipline to what the market was doing right now. He was a pioneer who sought to replace the volatile brilliance of the individual with the dependable consistency of a well-designed methodology. This video tells the story of that quiet revolution. We will explore the life and the unbreakable rules of Richard Donchian, the man who became known as the father of trend following. We will deconstruct the elegant simplicity of his systems, most notably the Donchian Channel, and we will analyze the profound psychological and philosophical shifts that his work represents. His legacy is the enduring proof that in the long marathon of the markets, a simple, robust, and disciplined system can, and often will, outperform unaided human genius. He taught the world not how to be a market wizard, but how to build a machine that could achieve wizard-like results. Before we continue, please subscribe and leave a quick comment, even one word. This small action helps the algorithm show this video to more people and tells me these deep dives are worth making. Richard Donchian's journey to becoming the father of trend following was not born of a single flash of brilliance, but was forged over decades of observation, intellectual curiosity, and one of the most formative financial disasters in history. He was born in 1905 in Hartford, Connecticut, the son of Armenian immigrants who had established a successful Oriental rug business. This upbringing gave him an early, tangible, and unconventional education in market cycles. Long before he ever saw a stock chart, he witnessed firsthand how the value of a high-quality, handmade rug could fluctuate based on changing tastes, economic conditions, and the laws of supply and demand. He learned to appreciate quality and value, but also to respect the powerful, often irrational tides of the market. His formal education took him to Yale University, where he studied economics, and then into the heart of the financial world in the 1920s. He entered Wall Street during the final, most euphoric phase of the Roaring Twenties bull market. Like so many of his generation, he was caught up in the new era narrative, the belief that stocks were on a permanently high plateau. He invested his capital using the conventional wisdom of the day. Buy good stocks and hold them for the long term. And then, in October of 1929, the world fell apart. The Great Crash was the crucible in which Donchian's entire philosophy was forged. He suffered significant painful losses, watching as the value of his holdings evaporated in the deluge of panicked selling. For him, this was not just a financial loss. It was an intellectual crisis. The experience taught him a brutal and unforgettable lesson. The buy and hold strategy, so praised in times of prosperity, was a recipe for catastrophic ruin when the tide turned. He realized that a successful market operator could not afford to be passive. Risk management, he concluded, was not an optional extra. It was the single most important component of any viable long-term strategy. This personal disaster was the catalyst that set him on a lifelong quest to find a better way, a more logical, more disciplined, and more defensive approach to navigating the treacherous waters of the financial markets. His quest led him to a simple but profound observation. After studying decades of price data, particularly in the volatile commodity markets, he noticed that prices had a persistent and powerful tendency to move in large, sustained trends. A market that was going up tended to continue going up, and a market that was going down tended to continue going down, often for far longer than most people believed possible. This led him to his most radical and important conclusion. The game was not about trying to predict the exact moment a trend would reverse. It was not about the fool's errand of buying at the bottom and selling at the top. A far more logical and profitable strategy, he reasoned, was to simply wait for a trend to clearly establish itself, and then follow it for the majority of its duration. He was not interested in being the first to a party, nor the last to leave. He was interested in being there for the main event. This was the birth of his trend-following philosophy. Over the course of his long and distinguished career, Donchian distilled his hard-won wisdom into a series of what he called trading guides. These were not complex formulas, but a set of clear, concise, and timeless rules for navigating the markets. They represent a complete philosophical and psychological framework for a systematic trader. Let us dissect the most important of these rules, the pillars of the Donchian Code. The first pillar is the supremacy of the trend. Donchian's rules are built on a deep and abiding respect for the power of the primary trend. One of his guides states, "The trend is your friend. Trade in the direction of the trend." This may seem simple, but it requires immense discipline. It often means buying a market that is already making new highs, an act that feels psychologically uncomfortable for the amateur who is always searching for a bargain. Donchian taught that a new high is not a sign of expense, but a sign of strength. His rules demanded that a trader act on clear indications of a trend change, but avoid getting in so late that the major move is already over. The goal is to capture the thick, profitable middle of a trend. He also provided guidance for trendless periods, advising traders to reduce their activity in sideways markets where trend-following systems are prone to small, frustrating losses. The second, and perhaps most critical pillar, is the sanctity of the exit. Donchian understood, perhaps better than anyone of his generation, that long-term profitability is not determined by your winning trades, but by how you manage your losing trades. His rules are a masterclass in defensive capital management. He preached relentlessly to cut losses short. This is achieved through the unwavering use of protective stop-loss orders. For Donchian, a stop-loss was not a suggestion. It was an absolute, non-negotiable law. It was the mechanical tool that removed ego and hope from the equation of a losing trade. The counterpart to this rule is equally famous. Ride your winners. He taught traders to trail their stop-loss orders as a trend moves in their favor, allowing a profitable position to grow while protecting the accumulated gains. This simple combination, cutting losses quickly and letting profits run, is the mathematical secret to successful speculation, yet it runs completely contrary to the average person's instinct to snatch small profits and hold on to large losses. The third pillar concerns the mechanics of engagement. These are the tactical rules that ensure a sound philosophy is not undone by poor execution. Donchian was a strong advocate for diversification. He knew that no single market trends all the time. By applying his system across a wide array of different and uncorrelated markets, from currencies and commodities to financials and agricultural products, the overall portfolio becomes smoother and less volatile. A losing streak in one market can be offset by a winning trend in another. He also warned repeatedly to avoid overtrading. A systematic trader, he taught, waits for the system to give a clear signal. They do not trade out of boredom, impatience, or a desire for action. The final pillar is psychological discipline. Donchian understood that even the most perfect system is useless if the operator does not have the mental fortitude to follow it. His rules are designed to build a fortress against emotional decision-making. He warned traders to beware of acting on tips and be cautious of your own wished-for positions. A systematic trader acts on the signals generated by their proven model, not on rumors or their own hopes for what the market should do. They must cultivate a state of objectivity, viewing the market as a stream of data to be acted upon, not an opponent to be beaten. His entire body of work is a testament to the idea that successful trading is, at its core, a systematic, not an emotional process. He was laying the groundwork for a new type of trader, one who would succeed not through flashes of brilliance, but through the quiet, consistent, and unwavering application of a set of unbreakable rules. Richard Donchian's philosophical rules provided the intellectual why, but he knew that for a strategy to be truly robust, it needed a mechanical how. He sought to create a tool, a system so objective and so clearly defined that it would remove the treacherous variables of human emotion and opinion from the trading process entirely. He needed a way to translate his core belief, follow the trend, into a set of non-discretionary, universally applicable commands. The problem he had to solve was fundamental. How does one objectively define a trend? How do you know, without resorting to gut feeling or personal bias, when a new high is truly significant, or when a new low signals a genuine change in direction? His solution was a work of elegant simplicity and profound insight, an invention that would become the cornerstone of his legacy and the foundation of modern trend following, the Donchian Channel. To understand the genius of his system, we must first build it from the ground up, just as he did. The process is a masterclass in logical simplicity. First, you must choose a look-back period. Donchian experimented with many, but his classic, most famous parameter was 20 trading days, which conveniently corresponds to 4 trading weeks. At the end of each trading day, you perform 2 simple calculations. First, you look back over the preceding 20 days and identify the single highest price the market has reached during that period. You make a mark on your chart at that price level. Second, you perform the same operation for the lowest price, looking back over the same 20-day window and making a mark at that level. When you connect these marks day after day, 2 distinct lines begin to form on your chart, creating a dynamic channel that envelops the price action. The upper line represents the 20-day high and the lower line represents the 20-day low. This is the Donchian Channel. Think of it not as a predictive indicator, but as the market creating its own, constantly updating boundaries of its recent history. It is a pure, unbiased visual record of the highest high and the lowest low over your chosen time horizon. It is a perfect, logical definition of the market's most recent trading range. And within this elegant construction lay the engine for his entire trading system. The trading rules that Donchian built upon this channel are the epitome of mechanical clarity. There is no ambiguity, no room for interpretation. The rules are absolute. His classic 4-week rule states the following. You initiate a long position, you buy, when the current price closes above the upper line of the 20-day Donchian Channel. You initiate a short position, you sell short, when the current price closes below the lower line of the 20-day Donchian Channel. The logic behind this entry signal is powerful. A breakout above the highest high of the last 4 weeks is not an arbitrary event. It is a sign of undeniable objective strength. It signifies that the buying pressure in the market has been strong enough to absorb every ounce of selling pressure that has existed over the past month, and has the force to push the price into new, uncharted territory. When you buy this breakout, you are not predicting that a trend is about to start. You are acting on the hard evidence that a trend has already begun. You are not a prophet. You are a pragmatist, joining a move that has just proven its own existence with decisive force. But if the entry rules are clear, it is the exit strategy that reveals the true systematic genius of the Donchian method. How do you exit a trade? And when? Donchian's answer was to use the channel itself as a complete self-contained system for managing the position. If you are in a long position, your protective stop loss is the lower channel, the 20-day low. If you are in a short position, your stop loss is the upper channel, the 20-day high. And here is the masterstroke that transforms this from a simple entry technique into a complete professional trading system. When your stop loss is hit, you do not simply exit the market and retreat to the sidelines. The moment your long position is stopped out by the price hitting the 20-day low, that very same signal is your new mandatory order to initiate a short position. It is a stop and reverse, or SAR system. The signal that closes one trade is the exact same signal that opens the next trade in the opposite direction. The philosophical implication of this is profound. A pure Donchian trend follower is always in the market. They are either long or short. They have no personal opinion, no bias, no forecast. The system alone dictates their state. The market itself, through the objective mechanism of the channel, tells them whether to be a bull or a bear. This is the very definition of a mechanical trading machine. The psychology of this machine is what makes it so effective. It is designed to systematically override the self-destructive instincts that plague the amateur trader. Firstly, it eliminates emotion. There is no room for the corrosive questions that haunt a discretionary trader. Should I take my profits now? The system answers, no, you will hold until the opposite channel is breached. This loss is getting bigger should I hope it comes back. The system answers, no, you will exit and reverse your position the moment the stop is hit. All the decisions have been made in advance, freeing the operator to focus on the one thing that matters, flawless execution. Secondly, the system forces discipline. It compels the trader to do what is psychologically difficult but statistically profitable, to buy new highs and to sell new lows. It forces you to ride a winning trend for weeks or even months, enduring all the painful but minor corrections along the way, because the system's exit rule has not been triggered. And most importantly, it forces you to cut your losses without hesitation. It is critical to understand that this system is not designed to be right all the time. In fact, it is designed to be wrong frequently. During periods when a market is trading sideways with no clear direction, a Donchian system will generate a series of small, frustrating losses known as whipsaws, getting in long at the top of a range only to be stopped out and reversed to short at the bottom over and over. This is the cost of doing business for a trend follower. The system is engineered to accept these small, frequent losses in order to guarantee one thing, that it will be positioned to capture the enormous game-changing profits that come when a major once or twice a year trend finally emerges and runs for months on end. Donchian knew that this psychological profile, enduring long periods of small losses, could be difficult for a trader to handle, even with a disciplined mindset. His solution to this problem was another of his great pioneering contributions, radical diversification. He understood that no single market trends all the time. While soybeans might be stuck in a sideways range, gold might be starting a new bull market. While the Swiss franc might be trendless, treasury bonds might be in a powerful decline. He was one of the first to apply his trend-following system not just to one market, but to a broad, diversified portfolio of dozens of different and, crucially, uncorrelated futures markets. He traded currencies like the Deutsche Mark and the Japanese yen. He traded agricultural commodities like soybeans, sugar, and cotton. He traded precious metals like gold and silver. He traded financial instruments like treasury bonds. By trading the system across this wide array of markets, the overall performance of the portfolio becomes dramatically smoother. The whipsaw losses in one sector are offset by the trending profits in another. This diversification not only reduces the portfolio's overall volatility and risk of ruin, but it also provides a crucial psychological benefit. It makes the system far easier to adhere to during the inevitable drawdowns. This sophisticated, diversified, and systematic approach led to Donchian's final great innovation. In 1949, he founded one of the very first publicly available investment funds in the world, a fund called Futures, Inc. He later went on to develop and manage other funds at financial firms like Shearson Hayden Stone. This was a revolutionary act. He was democratizing access to a professional trading strategy that was previously the exclusive domain of a handful of wealthy insiders. He was not selling stock tips, secret insights, or promises of quick riches. He was offering investors a transparent, disciplined, and systematic process. This role as a public fund manager cemented his reputation and his title as the undisputed father of the entire managed futures industry, an industry now worth hundreds of billions of dollars. He had successfully and completely transformed a philosophical idea, the trend is your friend, into a tangible, testable, and scalable trading machine that would change the face of Wall Street forever. The true measure of a great thinker is not just their own success, but the degree to which their ideas influence and empower future generations. By this standard, Richard Donchian's legacy is immense. He was not merely a successful trader, he was a teacher, a mentor, and the quiet architect of a revolution in thought that would fundamentally reshape the landscape of professional trading. His influence is most profoundly seen in two key areas: his role as the intellectual inspiration for the most famous trading experiment in history, and his status as the foundational builder of the entire managed futures industry. In the early 1980s, two of the most successful commodity traders in the world, Richard Dennis and William Eckhart, were engaged in a classic philosophical debate. Are great traders born, or are they made? Dennis believed that anyone with the right training and a solid set of rules could be taught to trade successfully. Eckhart argued that true trading talent was an innate, unteachable gift. To settle the argument, Dennis launched a now legendary experiment. He placed an advertisement in the Wall Street Journal, recruiting a diverse group of ordinary people, including a security guard, a professional blackjack player, and an aspiring actor, and taught them his complete rule-based trading system. He called his students the Turtles. The experiment was a phenomenal success. Over the next few years, the Turtles would go on to earn an aggregate profit of over $175 million, definitively proving Dennis's point that trading could in fact be taught. But what exactly was the system that Dennis taught them? At its core, the turtle trading system was a direct intellectual descendant of the principles pioneered by Richard Donchian. It was a sophisticated and optimized version of a Donchian Channel breakout system. The turtles bought when the price broke above its recent highs and sold when it broke below its recent lows. Their methodology included more advanced rules for position sizing based on a market's volatility, a concept known as the average true range, and specific rules for adding to winning positions, or pyramiding. But the fundamental DNA of the system, the unwavering belief in following the trend, the mechanical entry and exit signals, and the absolute necessity of iron-willed discipline, was pure Donchian. The phenomenal success of the Turtles was, in many ways, the ultimate vindication of Donchian's life's work. It proved on a grand and public scale that a simple, logical set of rules, when followed with unwavering consistency, could empower ordinary individuals to achieve extraordinary results. Richard Dennis may have been the father of the Turtles, but Richard Donchian was, without question, their intellectual grandfather. His influence, however, extends far beyond that single famous experiment. Donchian's creation of one of the first publicly managed futures funds in 1949 was the seed from which an entire global industry would grow. Today, the multi-billion-dollar managed futures industry, also known as the Commodity Trading Advisor, or CTA, industry, is a dominant force in the world of alternative investments. And at the core of this vast industry lies the simple, robust engine that Donchian designed. A typical CTA is a professional money manager who uses systematic, algorithmic models to trade a diversified portfolio of global futures markets. While their modern algorithms are infinitely more complex and their data processing capabilities are light years beyond what Donchian could have imagined, the fundamental philosophy of the vast majority of these funds is a direct echo of his work. They are, at their core, trend followers. Their primary source of profit, their alpha, is derived from systematically capturing the large, sustained trends that periodically emerge in financial markets. They are rigorously diversified across dozens, sometimes hundreds, of uncorrelated markets, from currencies and commodities to global stock indices and government bonds, and their entire operation is built upon a foundation of absolute, non-negotiable risk management. The DNA of the modern CTA industry, its systematic nature, its trend-following core, its global diversification, and its defensive, risk-first mindset, can all be traced directly back to the principles and practices pioneered by Richard Donchian decades earlier. This raises a final critical question. Why do his ideas remain so powerful? In a world of high-frequency trading, complex algorithms, and artificial intelligence, why haven't these simple decades-old rules been arbitraged away? The answer lies in their profound simplicity and robustness. Complex trading systems, often curve-fitted with dozens of variables to perfectly match historical data, are often incredibly fragile. When market conditions inevitably change, these complex machines break down. Donchian's rules, on the other hand, are based not on a complex set of assumptions, but on a single, timeless, and fundamental truth about the nature of markets. They trend. Trends exist for a reason. They are the visible manifestation of the enduring, unchanging realities of human psychology. Bull markets are not just random walks. They are powerful feedback loops of optimism, greed, and the herd instinct. Bear markets are cascades of fear, panic, and forced liquidation. As long as human nature remains a constant, markets will continue to trend. Donchian's system is not a predictive tool. It is a purely reactive machine designed to identify and exploit this single unchanging feature of market behavior. It does not need to know why a trend is happening, what the news is, or what the economy will do next. It does not need to know when a trend will end. It simply follows with resolute and unemotional discipline. And in that simplicity lies its enduring genius. He created a system that was as timeless as the human emotions that drive the market itself. The legacy of Richard Donchian is not one of spectacular, headline-grabbing trades or a dramatic rise and fall. It is the quiet, profound legacy of a revolutionary thinker who brought the scientific method to the art of speculation. He proved that in the long-term game of trading, the victor is often not the most brilliant, but the most disciplined. He was the quiet revolutionary who systematically replaced the chaotic impulses of human intuition with the cold, hard logic of a rule-based plan. His life's work stands as a testament to the idea that a simple, robust system, when executed with flawless, unwavering consistency, is the highest form of market mastery. The systematic and unemotional approach of Donchian is a powerful and complete philosophy, but it stands in stark contrast to the other great style of market operation, the world of the intuitive speculator who lives and breathes the market's every move. To understand this other extreme, this world where psychology, not the system, is king, and to immerse yourself in the mind of its greatest and most tragic practitioner, this entire journey, with all its psychological depth, is masterfully chronicled in Edwin Lefebvre's Reminiscences of a Stock Operator, which is presented as a fictionalized biography of Livermore. It is arguably the most important book ever written on trading, and its central theme is the brutal but necessary education in managing risk. For those who are committed to a deeper, more methodical study of these principles, we highly recommend the edition that features a unique, detailed chapter-by-chapter analysis by Max Davidson, an interpretation specifically designed to translate this century-old wisdom for the modern reader. A link to this essential edition has been provided for you in the description below. Today, we have dissected the systematic approach of Richard Donchian. But do not forget the other great schools of thought: the art of speculation and tape reading from Jesse Livermore, the analysis of market structure and the actions of smart money from Richard Wyckoff, and the deep understanding of time cycles from William Delbert Gann. Each of them offers a unique and powerful perspective on the market. All links to the channels for their in-depth study can be found in the description of this video.